Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. We're doing it again, giving you some sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. I don't want you to just survive retirement. That's not what you've worked your entire life for. I need you to make sure that you're thriving in retirement. And that means working with a multidisciplinary team in each of the areas of wealth management so you can curate that family office experience for yourself. Now, one of the first things I got to go ahead and make sure people are aware of is if you've got people that you love and they love you back, you have to do some basic estate work or you're going to be in trouble. If you've got a business, you need to do some advanced estate work. If you've created levels of financial success, then oh my, you need to get into some of the acronyms like SLATs and other things because you want to take advantage of the current Tax Cut and Jobs Act because yes, is it likely going to be replaced by the big beautiful bill? Of course it is, but nothing is finalized, so we need to protect you. David, what are the two very simple documents that everybody has to have without compromise, the documents we use while we're alive?
Powers of attorney for healthcare and powers of attorney for property.
And in those, are we naming executors, trustees, or are we talking to somebody else?
No, we're naming agents, right? So if I'm unable to make decisions on my own, then in most cases, I want my spouse to jump in to go ahead and make those decisions for me, acting in that fiduciary capacity.
And after you've got that durable power of attorney for healthcare, durable power of attorney for property, you're creating that agent. That's advocacy, someone who's going to advocate for you should you be temporarily sick, temporarily injured, etc. You got to make sure you have another piece, which is you got to have that HIPAA waiver. And I want that HIPAA waiver not just being extended to your agent. I want it being extended to all of your loved ones. And David, make sure you give that distinction to our audience. Why is it not enough just to have the power of attorney for healthcare where we're empowering our agent, our advocate? Why do we want this HIPAA waiver going to other people as well?
Well, because in most cases, life is dynamic. So if I'm in the hospital and my wife, Brooke, comes to visit me during the day, there's a chance she's probably going to have to go home later to get some sleep. And so if my sister-in-law or my brother came to the hospital, I still want them to be able to communicate with my physicians. They can't make decisions, but we need that open line of communication. And if you think about it for yourself, right, you want your physicians to be able to communicate with all of your doctors, but you've chosen one person to make that final decision for you. It's just living in the real world.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. If you need a refresh of your living documents, we're ready to help you today. That's your powers of attorney for healthcare, powers of attorney for property with your HIPAA waivers. Now, David, there's another document that applies to everybody, another document that's non-negotiable. And that's a document that gets used at death. And David, that's not our trust. The document we're referring to here is deemed what? And who's the role player that we're going to be named? What are they called?
Yeah, that's our will, right? And with a will, we have an executor. And in often cases, if you think about it, your agent on your power of attorney for property, it's probably going to be the same person that's going to be your executor. And in often cases, it might be your trustee, right? But that will, I kind of view, if you have a trust, as your net, right? It's going to catch maybe any of the assets that didn't go into your trust. So even if you've got a trust, you still have a will, but oftentimes it's a much shorter document, that pour over will, just to make sure everything goes through the trust and your distribution plan works properly.
Fantastic. So everyone gets powers of attorney for healthcare, property, plus HIPAA waivers. Everybody gets a will. And in that will, we're naming an executor. But it's super important, David, that we bolt something else onto that will. And that's called the digital executor. Talk a little bit about why digital asset protection is all of the rage today, and why people need to have a digital executor in their estate plan, because if they don't have one, they're coming up short.
Yeah, I mean, most of our life is online. So whether it's social media accounts that are holding pictures, whether it's these days people holding cryptocurrency, online bank accounts, all of these different things, airline miles you may have accumulated over the last 25 to 30 years of traveling for work. You know how things work today. It's very quick. And if, someone has a email account and you're trying to get into a deceased person's email account, it's not going to be very easy when you call them unless you have the proper documents in place. So this is the world that we're living in. Whether or not people like it is a different story, but you've got to make sure you've got those documents today, because everybody has some type of footprint online.
Yeah, listen, you have emails, you may have Facebook, you may have Instagram, you may store pictures, videos, movies, other digital content that's out there, and you signed a user agreement. You know what you did? You just took your mouse or your cursor and you scrolled to the bottom and you hit I agree. But that user agreement terminates when you die. If you do not name a digital executor, a digital asset executor as a part of your will, you're going to come up short. I want to make sure that never happens. 833-964-PLAN, 833-964-PLAN. Connect with us at getretired.stay-retired.com. Well, David, we talked about the documents we use while we're alive, powers of attorney for healthcare, property, HIPAA waivers. We just talked about a document everybody has, regardless of the sophistication of their estate plan. That's a will, where we name an executor, but we also build in a digital executor. And then that gets into the three categories, right, David? The three categories. We have testamentary trusts, which are great for a certain type of family who's starting out. We've got the family or the joint trust, which is a great strategy for a lot of families. And then we've got the his and her revocable trust with credit shelters. Break it down. Where do a lot of families get started and why?
Yeah, well, a lot of younger families get started with those testamentary trusts. And part of the reason for that is oftentimes they might not have had time or the opportunity to create a substantial amount of assets yet. Maybe their assets are just IRAs and 401ks, and those typically aren't held by your trust. So they need something to protect their minor children. They need something in case something would happen to them. But the process, right, of funding that testamentary trust is probate. And oftentimes people don't want to go to probate. But for younger families, in certain cases, I think that's a fine way to go. Then we move on to what we call joint trusts. Think of it like having a joint bank account. And typically the driver on that is when we're both gone, we don't want our kids going through probate. So we're kind of moving up to level, call it 201, right? Now there's several reasons that people do trusts. It could be trying to protect money from spouses. It could be trying to protect money from creditors, things of that nature. But generally speaking, I would say the number one reason that people say I want to start looking at doing trust work is they want to simplify when they're gone, and they'd rather pay a little bit more money up front as opposed to their trustees having to jump through a lot of hoops when they're gone.
So let's pause there, David. If you want to solve for three things, number one, you want to make sure you avoid probate, check the box. Number two, you want to minimize or disrupt some form of taxation. This is going to help. And number three, you want a message, meaning not give monies to the ones you love, but put the ones you love in a position to be successful. That's messaging. Then doing some basic revocable living trust structure is definitively for you. It helps you maybe keep the money all the way through the bloodline, help you avoid probate, help you minimize some transfer taxes. It's a great spot to be. But David, after we get through level 101, testamentary trust, level 201, revocable living trust, we get to level 301, which is, David, some people, especially they live in Illinois, shout out, if you live in Illinois, once you get above what number, David? It's not one, it's not two, it's how many million?
4 million.
Once you're above $4 million, I got news, everybody. Springfield's coming for a piece of your estate. Add up your house, add up your business, add up your life insurance, add it all up. And for you, if you're in that category, then you absolutely need some trust documents that have credit shelters so you too can protect. And I would argue, if you've really made it, if you've gotten monetized on your business, you've gotten monetized through options, you don't just need to do the basic stuff. You need to start adopting things like SLATs, spousal lifetime access trust, and other sophisticated planning techniques, while the estate tax exemptions are at their all-time highest, which they are right now in 2025, because you can't trust Congress to do good work and protect you. If you want some help, we can do that. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, click on the portion that says useful guides, and you'll see too our legacy and estate planning guide and how to successfully communicate your estate plan. Get those guides for free today at getretiredstayretired.com, and we stand ready to help you craft your last manuscript in 2025. More to come. AM 560, The Answer.
Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
If you find yourself within 5 years of retirement, this segment is for you. But in case you missed it, we just did a breakdown of the documents you need while you're alive, the documents everybody has to have at death, the documents that we use to solve for messaging, probate avoidance, reducing death transfer taxes, and messaging. Check us out, getretiredstayretired.com. Check us out, getretiredstayretired.com. Download our useful guide on legacy and estate planning so you too can put yourself in a position to be successful, and we stand ready to help. But again, I say it here, if you're within 5 years of retirement, you know that you're in the red zone, and there are small actions that can have outsized benefits when it comes to retirement. And some of the things we talk about, I start basic, we'll get sophisticated in a minute, but David, we talk about knowing your expenses. Talk about how it's so important in that planning process to be honest about what your expenses are, and how do we help people curate and get there?
I always say you don't want to rationalize that you can live off a certain subset of money just because you're looking to exit the workforce. So, I think it's realistic, right? Not everybody that we work with runs their household off Quicken or an Excel spreadsheet. So for a lot of folks, they feel like they've been good earners, they've been responsible and saving, but they don't know where every dollar goes. And I don't think that that's a means you need to stop in your tracks and start tracking everything. But we do really need to be honest with ourselves of this is what it's going to take to get it done. And I think for a lot of folks, if they struggle with that, they need to find a firm that actually just works with folks on that sprint towards retirement or recently retired. Meaning, I know what it takes to get done, whether it's Illinois, Florida, California, Rhode Island, Alaska. But I would rather overestimate than underestimate on all of this stuff. And a good way to think about it is well, what are you bringing in now? After taxes, after 401k contributions, after all these deductions, if you're really struggling, I think that's a great place to start is what are you actually taking home today? And let's start matching that up with what's realistic to withdraw from your portfolio. And then let's figure out all of these little things like how much is your Medicare going to cost? What kind of supplement are you going to take? A good firm can help you figure out where that sweet spot is.
And that's a good segue into part number 2. So you heard it there. We're talking about the 5 things that you've got to get done if you're within 5 years of retirement. And part number 1 is being honest about the spend. And if you didn't pick up on it, we've got clients that are retired in 41 states. We know what it takes, generally speaking, to run a household. We know what it takes to run a household who has a home and a vacation property, what it takes to run a household when it's a home and a vacation property that's a condo versus a single family dwelling. We know all these different things. And if we don't know them, we can help take apart your tax return. That's what you got to do. You can't do it with the pay stub. You got to take apart your tax return to get a better appreciation for where you might springboard. And again, it's not just your needs, it's what you want. It's not surviving retirement, it's thriving retirement. 833-964-PLAN. That's 833-964-PLAN. But part number 2, David, you mentioned it. If we're within 5 years of retirement, you've got to have a health care plan. And David, there's a number of different avenues, from on exchange to Cobra to Advantage to supplement. How do we do this, generally speaking, from 10,000 feet to cut through the clutter and make it bespoke for each family that we serve?
Yeah, I mean, I think it's really unfortunate that a lot of folks who are making that leap into retirement feel so overwhelmed, especially with something like healthcare, where you need to be right with your decisions. But there are so many little details to kind of get your arms around. But I think you outlined it well, right? This is not a one size fits all strategy. Just like there's no one size fits all investment strategy, I highly doubt there's a one size fits all healthcare strategy. So, part 1, like you said, is Cobra is available. We need to figure out what that's going to cost. I think the benefit of Cobra is people kind of know what they're getting. They're staying on that employer plan. That doesn't work, right? Then we start moving to ACA compatible plans. Now, where the secret sauce on those plans comes in is, if anyone spent any time looking at the cost, you'll see that the cost of those plans could range anywhere from $400 a month to $2,000 a month, right? And what's going to dictate that? How much income you have in your tax return. So to Craig's point, if we can do the due diligence ahead of time and you're 5 years ahead of this, wouldn't it be nice to put you in a position to show that you have a lower income to maybe qualify for those subsidies if you're going to, say, retire at 63 and you've got 2 years up until you qualify for Medicare? I'd love to be able to show you ways to qualify for cheaper plans to kind of bridge that gap into Medicare.
That's so incredibly important, David. So what I'm hearing is you have clients that you have worked with who have 7-figure portfolios who are able to get premium tax credit subsidy if they need a plan prior to age 65 because they don't have enough Cobra distance. They don't want to pay Cobra rates. You can engineer that, and that's exactly why you start people so early.
I have a lot of families that do that. Not like one or two, a lot of families. But I will tell you the one consistent thing through all those families is they didn't start that planning process 6 months before they left work. They started that planning process several years before work so that they could line up their buckets. And we talk about it all the time on the show. I view financial planning as a puzzle or maybe a chessboard. You have created all of these resources, IRAs and 401ks and trust accounts. And the telltale sign of a great advisory firm is one that's thinking 2 steps ahead. How do we line up these income sources so that at this age, we can show that you can, make little income so you qualify for some of these benefits? You've got to put the work in up front so that you have opportunities down the road. If all of your money is stuck in a pre-tax 401k, you're really challenged. There's really not a lot of ways you can manipulate your income. The only way you can do that is just not take any money out of the account, right? So I think that's the key is to get ahead of it and put yourself in a position to be successful.
So number one is be honest about the budget. Let's make sure we understand not just what you need, but understand what you want. Part number two, we're talking about the things that you got to be doing 5 years out from retirement is figure out how we're going to move through that successive journey of pre-Medicare and post-Medicare and position your income tax return to win so you don't pay full freight for your health insurance. 833-964-PLAN, 833-964-PLAN. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. When you're on our website, download our publication, Navigating Medicare and Medigap. Download our publication for free today, Navigating Medicare and Medigap at GetRetiredStayRetired.com. David.
Yeah, I'll throw one more thing in there, which is oftentimes I say this tongue in cheek, but it's kind of the way things work. I'll ask people, how did you choose that particular supplemental plan for Medicare or something? And they'll say something like, well, my friend at work, this is what they took when they retired. So it sounded reasonable. I took it. Or my sister-in-law said they took that plan. And that's great, right? You want to have people that are using that, right? So you have a close resource. But what I would say is, if you think about the dynamic we have today, a lot of our families are very fluid with where they live. So if you're a listener in Chicagoland, dealing with healthcare in Chicagoland is different. We have a tremendous amount of providers, tremendous amount of hospitals around here. Now, if you move down south to Tennessee, to a more rural area, there might only be a couple of providers, meaning you might not have as much choice of what plan to take. And I think the reason that's important is there's a huge delta between the prices on all of these plans. So we can't just take it for, hey, that's what it costs in Illinois. If you're moving, you also need to start running the pricing and figuring out the opportunity sets and the providers for all these other places in the country.
Well said. We've been talking about the 5 things that you need to do in the years leading up to retirement. We talked about the budget, having the retiree healthcare plan. That brings me to number 3. Everybody puts off the kitchen renovation. Everyone puts off the home repairs. They put it off because they say, I'm going to do it when I'm retired. No. Do it now. We want people going into retirement. I want the house retirement ready. Let me say that again. You're going into retirement. We want the family home, your retirement home. I want it retirement ready. Why is that? Because number one, once you're retired, you don't want people banging and coming in and out of your house and ruining the first year of your retirement as you're navigating contractors. Part number 2, I find, regardless of how well curated a plan is, people tend to worry about money when they retire. It'll only be the proof after the first 5 to 10 years using processes that are TNT, tested in the trenches, that you have the freedom from worry because you know it's going to work out. So please go with us on a journey where we do the home repairs now. Get the house retirement ready. Don't wait for the driveway. Don't wait for the roof. Don't wait for the bathroom and the kitchen remodel. We want strategies to get those done while we're employed. We're going to talk more about the 5 things you need to do getting ready in the 5 years leading up to retirement after this break. In the meantime, check us out online, GetRetiredStayRetired.com. You're listening to Craig and David in the Know, AM 560, The Answer.
You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
You're within 5 years of retirement. You're in the retirement red zone. That's undeniable. And small actions today can have outsized benefits for the future. We talked about having the command of your expenses, having a plan to access your retiree healthcare, even potentially with discounted tax dollars. We just discussed, don't be putting off the home renovations. We want the real estate to be retirement ready. Get all the projects done before you retire. And that brings us up to number 4. David, I just find, and I think you see it too, and I need you to comment as a practitioner, that time and time again, I visit with people, and typically their regrets are everything they didn't do not so much the things that they did. And for me, that's why I say travel now. Can you elaborate?
I couldn't agree more. I was just thinking of an example as you were saying that from a couple of weeks back of a family that had a Viking River cruise that got postponed because the water level was too high. So it was a 2-year postponement. Now they're going back, and one of the people has a bad hip, and they already know that it's going to be a slower trip, and they're not going to be able to do all the excursions, right? But I hear oftentimes that like, I wish we would have done that when we were in better health. And now, we're going to have to go closer to home. So I think that's well said, right? If you are actually doing annual planning and you have, budgets to work off of, and that your retirement plan is going to work, then why do you have to wait until you stop working to actually go take that bucket list trip? Just do it now so that you can do it to the full extent, because going at 75% might not be as good as you imagine it to be.
That's right, David. And that's why I think we've said it time and time in the office. We're not here just to be someone's wealth advisor. We're almost here in a way to help them be a good steward, to be a caretaker. And that means having well curated financial plans so that people can live for today while they acknowledge and plan for tomorrow, because tomorrow's not promised to anyone. That's not like just a life or a death thing. That's a health thing. It's an opportunity thing. That's why we want to help you unlock these experiences. We all get to a certain age. We've had more than enough stuff. But what we really want is we don't need more stuff. We just need new and better experiences. And that takes a plan and a strategy to do it with confidence. I think number 5 on our list, as we discuss the 5 things you got to be doing in the 5 years leading up to retirement, is you almost have to have a retirement test drive. You got to have a retirement week, a retirement month, a retirement quarter. Seriously, David, you phrased it as what in the world's going to get you up out of bed every day once you retire? Don't get me wrong. It's going to be great to be at home. But David, if I say create a retirement model week, what does that mean to you, and how should people be incorporating it before they pull the ejection lever at their employer?
Yeah, I would interpret that in maybe 2 different ways. At the most basic level, I have a lot of clients kind of test retirement based off of cash flow. So, hey, if our game plan is that you need X amount of money per month, why don't we try living off X amount of money per month for the next several months, and let's just see how it goes, right? And I think if you're reasonable with your planning, you rarely run into issues. But every now and then, someone might say, "Hey, well, look, we tried it, but actually, we may have underestimated what we've been spending, so we need to go back to the drawing board." Number 2 is a lot of people are moving, right? And they are moving because of taxes, but oftentimes they want to be closer to family. I don't see anything wrong with going on VRBO and renting a condo for a month or 2 in a different place to see if you like it, right? I mean, it's hard to buy places in certain areas of the country because they're hotter markets. But I think we need to test drive that environment, because there's plenty of places to choose from, but you've got to kind of be there to know whether it's a right fit or not. And I think that's a great way before you commit hundreds of thousands of dollars to a second home is go out and spend the 5, 6, 7, $8,000 just to test drive the neighborhood first. And if you know this is the right fit, then we can go look and make that acquisition.
You know what? We just got done talking about the 5 things you got to do leading up in the 5 years to retirement because you're in the red zone. I want you to pair that with something actionable. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com, and download today our 5 keys to retirement planning guide. That's download today for free at getretiredstayretired.com, our 5 keys to retirement planning. Now, David, something that I think is really important is people just get stressed, and there's some signs, I think, that retirement spending might be getting people stressed. And I want to run these by you to get your reaction. I think the first one for me is I see people where they're just the world, the headlines. It could be a post is stressing somebody out. And if the world is stressing somebody out, maybe that's happened in the last few months. I think they're stressed because they don't have a plan. People talk about retirement income plans. People talk about financial plans. People talk about retirement plans. How do we do it at VestGen Wealth Partners? And how can that alleviate someone's stress?
At the end of the day, I think a lot of these problems or crises are shorter term problems, right? So they create a lot of market chaos over several months. Eventually, cooler heads prevail, markets start to recover. But I think a lot of the challenge is as people are taking distributions from their accounts and not adding to those accounts, they don't actually know where the money's coming from. They've got a big bucket of money and they know they take out, let's say, $5,000 a month. But where is that money actually coming from? So one of the big things that we try to do here is we try to keep it simple and create a lot of transparency and actually show someone on their statements or on their holdings, these are the parts of the portfolio that will generate your monthly income over the next several years. And if you do that and keep it simple in times of stress, I think you can go back and say, okay, so when is this thing going to be resolved? Because I've got the next 5 to 6 years of safe money kind of already lined up. That should be plenty of time for things to get back to normal. And look, the stock market's done really well the last 5 years, but it hasn't been without a lot of these hiccups, right? So the proof's in the pudding, whether it was tariffs or whether it was COVID or whether it was spiking interest rates, that's the proof right there that if you do the planning early enough and you have the money lined up, that's, I think, your best, plan or your best advocate to make sure that you stick to the plan is to know where the money's actually going to come from.
And David, another sign of stress that I think is related to this, and I see it time and time again, is I'm going to call it out. There's too many people that are actually too heavily invested in stocks. I think there's too many people today who simply have a growth stock mindset. And that puts you in a position to fail when the numbers don't go your way. And David, in 20 seconds, can you talk about the significance of not being overweighted to stocks at this juncture in life?
Yeah, I mean, look, we just saw it. We've gotten several reminders over the last couple of years, but I think the big thing is markets move so quickly today. And so while it might feel good when earnings from tech companies come out well and you see these big moves higher, it certainly does not feel well to see a 20% decline in 2 weeks. And so if you're not spread out enough, it's going to cause a problem long term because it's going to force you to make a bad emotional decision.
Well said. So listen, we want to help you get retired and stay retired. 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. When we come back, we're going to give you some great investment ideas. You're listening to In the Know, VestGen Wealth Partners, Craig Bolanos, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So I thought for a moment that we just have to acknowledge the fact that there are still too many investors out there who are running with this growth-minded portfolio. And the truth is, I think people need to take some dollars out of public equity markets and bring them into private markets. And I think one of the ways we do that, though, inside of more of a stay wealthy strategy is, again, revisit the world of private credit. So, David, when I mention private credit, for me, clients own treasury bonds. They're loaning money to the U.S. government. Clients own municipal bonds. They're loaning monies to municipalities and states. Clients own corporate bonds, whether it's individual bonds or defined maturity bond funds, aka funds that have a known maturity date. So people know when they're getting their money back and they can calculate their yield to maturity. That's loans to publicly traded corporations. I view the world of private credit as loans to private companies, but expand for us where private credit sits, how it can diversify someone's income, and how we could learn from private credit as maybe a substitute for equity dollars if people believe that the next 5 to 7 years of public equity growth, aka the S&P 500, isn't going to be as robust as it was for the last 5 to 7 years.
Yeah, well, I mean, there's lots of different segments of private credit, right? That's a general topic, but you can think about it in a couple ways. So the first way would be private credit. You are the lender when a private equity firm acquires another company. And the way I think about that and the way I think that's exciting is that means you're going in on the deal with someone else. It's not just a pure loan to some corporation. It's a loan to a private equity firm who's acquiring a company. And remember what the job of that private equity firm is. It's to make money, right? And they're pretty darn good at it in most cases. So you have someone else going in the deal. And I think that's really exciting. Part two is, in what you're seeing a lot of now, is private credit is becoming one of the premier lenders also for very large corporations. And part of the reason for that is the deals get done very quickly. Anyone who's bought a mortgage in the last couple of years or even post 2008 knows you have to jump through a lot of hoops, right? How many times does the underwriter ask you for the same statements? And you're always saying to yourself, like, I just sent them last month's statements. Now I got to send them again. It takes a long time to underwrite that. Now, think about that. If that was for a business deal, how much more information that bank would need for private credit, right? They're still doing all that due diligence, if not more, but they're making the process quicker. And because they make the process quicker and confidential, they're willing to pay a premium for those loans. And so now you end up loaning also money for other types of deals. And it kind of falls into with what you were saying, Craig. Let's turn this into like a thematic, right? So there are a couple of ways that you can play some of these tech thematics, right? Data centers is a very interesting one, right? And so, you can invest in the technology company, or you could be a lender to a very large technology company for the same type of deal. What you've got to ask yourself is, do you want the volatility from the equity side of that deal? Or do you want to be involved in the deal as a lender? Because if you're involved in the deal as a lender, that might come with a lot less volatility. And at the end of the day, if that private credit is paying 5% on top of SOFR, and I don't want to get into too many of the details on that, you're getting a pretty high compensation rate for a lot less volatility in the stock market. So I would just say, rethink about this. If you still like these technology, these emerging themes, equity or stock is not the only way to play them. How about you be the lender in the deal? Because again, if you're retired, your only job is to stay retired. So maybe that's an easier way to get involved, but with not all these huge ups and downs all the time.
No, that's correct. It's about getting retired and staying retired, and that means a focus on wealth preservation. It's a focus on income. So if you're looking to generate income, I would argue that investing in a portfolio of senior secured loans is a great diversifier to the portfolio. I think part number two, that defensive positioning, being in senior secured debt of large performing companies in resilient sectors, gives you a level of protection and a repayment priority that matters. That means it's ultimately a higher quality portfolio, normally comprised of what I call floating rate debt, secured overnight funding rate plus a spread. And you got to do it with the expertise of a well-established firm that's got a strong reputation in those markets, because you need to diversify your diversifiers and take advantage what is here today to look at being in that space. And you don't always have to have the risk of the equity sleeve. Sometimes it's a great option to simply be a lender in that space, as opposed to having the volatility risk that comes with being the equity sleeve. And David, if people want to learn more, I think they absolutely can and should. Give us a call, 833-964-PLAN. That's 833-964-PLAN. And let us share with you how you too can diversify your diversifiers in the second half of 2025 by looking at private credit as an opportunity. And David, you and I talked this week about there's really three gigantic trends that are out there, whether it be artificial intelligence, immunotherapy, et cetera. Give us a taste of what's happening and what's coming. And again, people don't just need to be an equity investor to do it. They can be the lender. What are some of those thematics, David?
Yeah, well, I mean, AI is certainly the most popular one, and one of the things I would think about as an investor is we all know the big publicly traded companies that are involved in AI, but if you look at the private markets right now and all of the money that's going into it, are those companies? And I'm not saying they're bad; they're great companies, right? Are those going to be the best performers moving forward? A lot of the companies that are making big strides are actually privately held companies still. So you can't access them through a mutual fund or an ETF. So I would keep that in mind. The other thing I would keep in mind is I don't think it's too late for any of this stuff, right? I mean, we're still early stage, but these are big game changers. And for everybody that has acquired capital over the last, several decades of working, I think you put it really well, Craig, is, if you knew what you knew today back on January 1st of this year, how would you have maybe reallocated money? This has nothing to do with being in or out of the stock market. It has to do with just making tweaks at the margins as we're all trying to be good stewards of capital. So if you can still get involved in AI, but maybe through a fixed income portion as opposed to an equity portion, that's a great thing to look at. If you knew now that people are concerned about slower growth with inflation, aka stagflation, go back. What was the playbook that people were using then? It's not the same playbook that people have been using for the last couple of years. So this is an excellent opportunity to keep going with these same themes, but I would say maybe think about just executing in a slightly different manner. And the key, and what we always say on the show, is you better find a firm that actually knows how to execute, because we went through a 15-year period where investment companies came out with all of these goofy products, but they really weren't any good. What's changed about that is there are more pure play ways to do it, and you want to align yourself with a firm that has good, long-standing relationships to get you access to the real stuff, not the watered-down versions.
David, I'm so happy you said that. We stand ready in the alternative space as a leader at VestGen Wealth Partners to do just that, to partner with the private equity solutions that other investment firms don't have access to, because you don't want to be in the watered down stuff. You want to be only in disciplines where the private equity firm and your advisor know it's a client first mindset, a client's first mindset. That's where the return stream comes from. 833-964-PLAN. Go out to our website, getretired.stay-retired.com.
Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
My heavens, we covered an awful lot of ground here on a Sunday morning, a lot of ground. And when I think about everything that we discussed, everything you need to make your estate plan work effectively. Again, stop talking about giving monies to the ones you love. Start messaging. Put the ones you love in a position to be successful. That's advocacy for yourself. Then that's transfer of money, the mitigation of estate and transfer taxes, messaging so that money doesn't leave the bloodline through divorce, money doesn't leave the bloodline through creditors. You can do all that with a well-curated plan, and we can help. make sure there's at least, we only talked about 5 things. There's really closer to 15, but there's 5 core things you've got to be doing in the 5 years that lead up to retirement, because small incremental changes now are going to have a gigantic impact longer term. What are some of the signs that you're not ready for retirement or your retirement's in jeopardy? We discussed the stressors. If the news headlines are stressing you, it leads to the fact that your plan isn't robust enough. If the news headlines are stressing you, it could simply be that you're over allocated to equity markets, and that's going to be a problem, especially if it's all on the growth side of the ledger, because you cannot expect the next 5 to 7 years to be a repeat of the last 5 to 7 years. And if you're thinking logically about something, you got to understand, David mentioned data centers, robotics, all these different ways. And you don't always have to participate with the risk of being an equity owner. You can participate by being a lender. And you can do that through private credit on the technology side, or you can just use private credit as a way to enhance and diversify the bonds that are currently in your portfolio. But when you've got distribution rates that are SOFR, the secured overnight funding rate, plus 5%, that's big yields in today's market. And especially when it's done with products and vehicles that are client first, I think that really matters. And I have to acknowledge that this week is very special to everybody. It is Memorial Day weekend. And one of the things that resonates with me is our nation is only going to remain the land of the free, so long as it is the home of the brave. To everybody out there, celebrate with me those fallen heroes. I'm Craig Bolanos, founder, VestGen Wealth Partners, 833-964-PLAN. Get Retired, StayRetired.com. That's GetRetired, StayRetired.com.